Good afternoon, everyone. Pleasure to have all of you here and going through this training. So let's just get started. For the most part, I do believe Mike has already gone through with all of you, as he mentioned, the product, rehabilitation, public service loan forgiveness, as well as the necessary information needed to quote a client for the programs that we're going to go over here. So what I'd like to do is start back from the top. So with that being said, we are first going to talk about the programs and products that you're going to be offering to consumers. So first and foremost, I believe Mike went over this with you and described the first family of products that are offered as Family 1. So I'm going to go over that again. Family 1 consists of your conventional types of loan programs. So these are conventional, meaning that what determines the monthly payment under these programs are the term, balance owed, and interest rate. Okay? So term, balance owed, and interest. Just like your conventional bank loan. So the first one of these programs we're going to go over is called a standard plan. Now, with a standard plan, you are going to have up to a 10-year loan term for a standard program. The way that these monthly payments are calculated is just as I mentioned. It's based off of the term that is set for 10 years, the balance that the client owes, as well as the interest rate on the loan. Now, what determines the interest rate is all dependent upon the interest rates on the loans that are being consolidated. So therefore, what I mean by that is, let's say a client has 10 loans with 10 different interest rates. Well, what's going to determine their qualifying rate on the new loan is a weighted average of those 10 interest rates that are being consolidated. So that is a standard plan in a nutshell. So standard plan, 10-year loan with payments based off term, balance, and interest rate. Now, with that plan, there are no early repayment penalties. The client can pay additional at any time to pay the loans off sooner. This may or may not be a fit for your clients depending on what their specific situation is. That is the standard plan. 10-year term, max. Next option is what's called a graduated plan, which I'm pretty sure that Mike already went over this with you as well. But for a graduated plan, same thing. It is a 10-year term, with the payment based off of the balance owed, interest rate, and the term. Now, the difference between a standard and a graduated plan is essentially the graduated plan is going to start the client off with a little bit more affordable payments in the beginning of the loan. So for the first 2 years, the payments will be a little bit less than what it would be on a standard plan, and then every 2 years, those payments are going to gradually increase depending on what the balances are, but typically that increase is 17% on every 2 years. So for instance, just to give you an example, for a standard plan, it would probably be, let's just say, on a $20,000 loan, you would probably have a monthly payment of maybe, let's say, $190 a month. That would be a fixed payment for the life of the loan. And again, there are no early repayment penalties. The clients can pay anything additional. Now, the difference between the standard and the graduated is that instead of on a graduated term, the payment starting at $190 on a $20,000 loan, the payments may start out at, let's say, $95 a month for the first 2 years. And then every 2 years, those payments are going to gradually increase, okay? Which may be very beneficial for those borrowers who are just getting out of school, getting graduated, and getting on their feet, who need a lower monthly payment in the beginning. And obviously those payments will increase as they are hopefully getting increases in pay at their job every couple of years. So that would be a standard and a graduated plan. And then you also have these same plans, but in an extended version. So you have an extended fixed plan, and you also have an extended graduated plan. The differences from the extended plans versus the first two that we just went over are that the extended fixed plan is going to offer a term anywhere from 15 years up to 30 years, depending on the borrower's total education indebtedness, meaning the amount that they owe on their loans. Same thing with an extended graduated plan. So it's going to be a 15-year term up to a 30-year term. Now, with an extended fixed and extended graduated plan, the monthly payments are still calculated the same. It's based off the term, interest rate, and balance owed, meaning that same as these plans, it's just going to matter of which term they're on that's going to determine what their monthly payment will be. Typically, these plans are going to offer your clients more affordable payments over a longer term, which may be very attractive for those clients who need lower payments and who want to combine all of their loans together for one loan, one payment, one servicer. So those are the Family One loans. These are your conventional programs that are available, and you're going to find that a lot of your consumers that you're talking to are going to want to take advantage of these plans, and because they will offer a lot of benefits as far as lowering their monthly payments and keeping them on a reasonable fixed payment schedule throughout the term of the loan. So those are your conventional programs. We have standard, graduated, extended fixed, and extended graduated. Now next, we're going to go over Family 2, which I believe Mike already went over with you as well. And this is just going to be a refresher to go over these. So with Family 2, bear with me here. Let me just make some room here. Family 2 is going to be your unconventional type of programs. And what I mean by unconventional is that with these plans, the monthly payments are based off of the borrower's total education indebtedness, total household income, and family size. So amount owed, household income, and family size. The difference between these programs and the other programs that we just went over are that the interest rate, term, and balance are not what determines the monthly payment. It's always going to be the amount they owe, their household income, and their family size. So with that being said, there are three programs that fall into this category. We first have the ICR plan, which stands for income contingent. We have the IBR plan, which stands for income-based repayment. And then we have the pay-as-you-earn plan. Now, the differences in these three plans are very, very simple. The only differences are that the income contingent is based off of 20% of the borrower's annual discretionary income. The IBR plan is based off of 15% of the borrower's annual discretionary income, and the pay-as-you-earn is based off of 10% of the borrower's annual discretionary income. Now, with all of these plans, the ICR has a maximum term of 25 years. Same thing for the income-based plan, 25 years. And then the pay-as-you-earn plan is going to be a maximum of 20 years. Now, each of these programs, if indeed they are on a max term that you see here, all of these programs offer forgiveness at the end of the term. So essentially, the borrower can take advantage of these plans, have payments set based off of their income and family size each year throughout the loan term. So basically, every year when the borrower files their taxes, whatever is showing for their total household income as far as their adjusted gross and the number of dependents that are claimed on that tax return will determine what their payments are under these programs each year throughout the loan term. And as long as those payments are made on time each month throughout the loan term, any remaining unpaid balance at the end of the loan term is automatically forgiven. So these are what I like to call your income-driven forgiveness programs. Now, for instance, with the income contingent plan, again, it's based off of 20% of the borrower's household income, maximum term of 25 years. So let's give an example. For instance, under all of these plans, we have a few factors that will determine a few factors that we use in order to calculate their payment. So one, like I said, amount owed, household income, and family size. So for instance, let's do a comparison here. Let's say we have John 1 and we've got John 2. John 1 has $60,000 in loans. John 2 has $60,000 in loans. John 1 makes $40,000 a year as far as his adjusted gross income. John 2 makes $40,000 a year as far as his adjusted gross income. Now John 1 is married and has 3 children that he claims on his tax return. John 2 is single and has 0 children that he claims on his tax returns. Now, for instance, I'm going to show you the benefits of these programs based on these scenarios. So John 1, $60K in loans, $40,000 in income, married with 3 kids, which means that in order to determine what his payments would be under either of these 3 plans, the income contingent, income-based, and pay-as-you-earn plan, we're going to look at the total amount he owes, the total household income, and the family size. So for instance, since John 1 is married with 3 kids, we would have a family size of 5 because it's John, his wife, and his 3 children. We would go off the total household income because John works, his wife stays at home with the kids, he doesn't work. So his combined income is $40,000 for him and his wife with a family size of 5. Now for John 1, his monthly payments under, for instance, an IBR plan here are going to look like this. He's going to have a 25-year term with, let's say, payments of $100 a month because he has a larger family size and owes $60,000 in loans and has $40,000 in income between him and his wife to take care of all their bills and their family each month. Okay. Now, with that being said, 25-year loan, $100 income-based plan because he has a larger family size. Typically, a payment under your conventional loans on a $60,000 loan would probably be $400 to $500 a month. Whereas in this case, you can see this is very beneficial for John because he has a larger family and paying $400 or $500 a month probably isn't very easy for him to meet on a monthly basis as far as that obligation goes. So therefore, either of these plans would give him a much more affordable payment. And not only that, as long as he makes the payments on time each month throughout the loan term, after the term is paid, if there's any remaining unpaid balance, it is automatically forgiven. So that's John 1. Now John 2, same scenario. The only difference is John doesn't have a family. He's single with 0 kids. So in this particular scenario, because John is single with a $40,000 income and $60,000 in loans, for John, he is going to be put on an accelerated term because he can afford to pay more because he doesn't have a family to take care of. So therefore, John 2, for instance, will probably be on, let's say, a 12-year term, and his payments will probably be, let's say, around $250 a month because he can afford to pay more. Same scenario for John 2. He makes the payment throughout the term that's set. After that term is paid, the loans are considered paid in full, regardless of if he's paid back the full principal and interest amount. So those are the real differences between the conventional plans, which is family 1, versus your unconventional plans, which is family 2. So family 2, ICR, IBR, pay as you earn. Now, as I mentioned with each of these plans, they are forgiveness programs, so it's very important to stress that to your clients when you're talking to them, because they can have payments based off their income and family size, and after the term is paid, the remaining balances of those loans will be forgiven, assuming there is an unpaid balance left over. So those are the major benefits of the ICR, IBR, and pay-as-you-earn plan. The pay-as-you-earn plan is always going to give the client the lowest payment as far as affordability goes, but keep in mind there is a restriction with this program. Borrowers cannot have loans taken out prior to October 1st, 2007. If they have loans taken out prior to October 1st, 2007, they are not eligible for pay-as-you-earn. They would only be eligible for an IBR, ICR plan. So that's one main restriction to be aware of when you are quoting your clients these programs. So that's Family 1, Family 2. As far as the programs go, that should be a little bit of a refresher. I would ask you guys if you have questions, and if you do, I would say if you want to type any questions you have at this point, go ahead and type them in the screen. We can address those real quick.
We have the option of raising your hand or asking questions.
So any questions? No questions?
Yes, John Beavis, get him on.
Okay, John, what is your question? Hang on 1 second here. We're going to get you so we can hear you. You there, John?
John, go ahead.
Hello, John. Are you there? No, okay. Can you repeat the last requirement for pay-as-you-earn? Yes. So for the pay-as-you-earn program, what I was mentioning is that there is a restriction for eligibility for that program. And the restriction for that is that the borrower cannot have any loans that were dispersed prior to October 1st, 2007. Does anyone else have any questions that they would like for me to address regarding the programs that we'll be offering to your clients?
Yeah, that was me.
No, I'm saying, I've been watching what you've been doing in Word.
Oh, this?
So, if none of you have any other questions, there is one other thing I'd like to touch on with these programs, is that it's very important that you make sure that you have, for these three programs, the income contingent, income-based, and pay-as-you-earn plans, it's very important that you have the borrower's total household income accurate, as well as the family size. And I'm going to go through a few different scenarios with you so you kind of understand what I mean, because you're going to run into different situations with different people that you talk to. So therefore, with these plans, okay, if you have someone who is married and files a joint tax return and has 3 children, okay, you're basically going to have a family size of 5, just like in John 1 scenario that we went over here, because we include the borrower, the spouse, because they file a joint tax return, as well as the 3 children that are claimed on the taxes. Now, for instance, another scenario, you will have a married couple, but if they file a separate tax return rather than a joint tax return, you will not include the spouse's income. You will only include the borrower's income and however many children or dependents the borrower claims on their portion of their tax return. So, for instance, if you have a married couple that files a tax return and the borrower claims 3 children, well then, you're going to have a family size of 4 rather than 5 in that scenario, because we would not include the spouse because they file a separate tax return. Now, obviously, if you have someone that is not married, files a single or head of household return and has dependents, you're going to count the borrower and whatever, children, however many children or dependents they claim on their taxes. So that is a very important factor to remember, because if you don't have that information correct, you are going to be quoting your clients the wrong information. So does anyone have any questions about that? No questions? Okay. Okay, I see your question, Maddie, and it says if filing single and married is the spouse included as a person in the household. Can you please clarify what your question is there, because I'm a little confused about what you're asking. Hang on one second, Maddie. I'm going to have Sean unmute you so we can hear you. I want to make sure we get your question answered. Are you there, Maddie?
Hi, I'm here.
Hi, how are you?
I'm good. How are you?
I'm doing fantastic. Glad to be here with you all. So what's your question, Maddie?
Okay, what I was trying to ask is, if somebody is married filing single, okay, and let's say it's the borrower, the person they're married to filing single, and 2 kids, is that a household of 4 or a household of 3?
Okay, so you're going to have a situation where if the couple is married and they file a separate tax return, which I think is what you mean, okay, in the
Yes.
event that they're married and file a separate tax return, you're only going to look at the borrower's tax return and go and use their income, not their spouse's income, and however many children or dependents the borrower claims on their portion of the tax return. So let's say, for instance, you've got a married couple that files separate and there's 3 kids. Well, let's say the borrower does a separate return and claims 2 of the children. It would be a family size of 3, the borrower and the 2 dependents that are claimed in that scenario. Does that make sense and clarify that a little more?
Yes, it does. Thank you.
No problem. My pleasure. All right. So you know what, guys? If you can hang on 1 second here, I need to grab a phone charger because my phone is going to die on you. So hang on 1 second. Sean, can you grab me a charger? Or you have one right there? And then I believe, James, you had a question as well?
One second, James. Who?
James Gripsover.
Okay, can you hear me now? Can you guys hear me okay?
Yes, I can hear you just fine. What was your question?
So if we're speaking with someone and they have not filed their taxes for this year, can we recommend for them either filing individually or joint if we see there's an advantage for them to reduce their payment?
That is a great question, James, and the answer to that question is yes. Obviously, we're not tax advisors, but what we can do is advise the client of what the benefit would be if they did a separate return versus filing a joint return, because in a lot of scenarios, you will find that if they do a separate return and only look at the borrower's income and however many children or dependents are claimed on that borrower's tax return, then yes, their payments could be much more affordable than versus looking at their combined adjusted gross income.
Right on. Thank you.
Does that clarify that?
It does. Thanks.
All right. Anything else you had a question about there, James?
No, just that specific topic.
All right, James, I'm going to mute you back. So does anyone else have any further questions before we move on from the programs that are offered? How about you guys? Any questions? Hang on 1 second, Maddie. Okay, Maddie, go ahead. What was your question?
Okay, if somebody has not filed their taxes, let's say for 2013, and they're telling us that they're not going to file based on whatever the filing requirements are, them not making enough, is that the case where they'll just need to provide a certified letter and whatever proof due to the lack of income because they're not filing?
Yes, that is correct. If you have someone who doesn't file a tax return, that's when we will always have them fill out that self-certified letter stating what their income is and what they're earning, okay?
Okay.
Did you have any other questions about that, Maddie?
No, thank you.
Okay, no problem. So is there any other questions from anyone else regarding these programs, determining the family size, household income, any of that for these income-driven forgiveness programs we just went over? All right. I'll take it that means that nobody else has any. Oh, Ralph. Ralph, you had a question. Go ahead.
Yeah, I was just wondering, does extended fix, does that qualify for student loan forgiveness?
No, it does not. Any of the programs under Family One, the only ones that would qualify for forgiveness would be the standard or the graduated. But keep in mind that's kind of a catch-22 because those are 10-year terms as it is, so they're going to have the loan paid off in 10 years anyway.
Okay, all right.
Does that make sense?
Yeah, I know the ICR, the ICR, they qualify for student loans. I was just wondering about extended fix.
No, it's a great question. The only programs that are going to offer forgiveness are the income-driven programs. So the income contingent, income-based, and pay-as-you-earn plans.
Okay. Yeah, for the public student loan forgiveness. Okay. All right, thanks.
Exactly. Well, here's the thing, okay? All of those plans offer forgiveness as it is. Now, borrowers can potentially have another form of forgiveness under those three plans as well, which that's the public service loan forgiveness, which we're going to go over here in a moment as well.
Okay.
All right, so I'll go into a little more depth on that as well once we get to that public service section here, okay?
All right.
So any other questions before we move on? All right, I'm going to take that. There are no other questions, and we're going to move on. So next we're going to talk about rehabilitation, which I know you guys are already familiar with that too, but I'm going to go into it a little bit more to make sure that we are all on the same page. So bear with me. Let me make some room here again.